Thank you, everybody, for joining today's webinar, brought to you by the Montreal Exchange in partnership with BMO InvestorLine. Today we're joined by Jason Ayres from OptionSource.net and regular presenter for us here. He'll be talking about option spread trading for the next 45 minutes to an hour. Just a note to all participants, on the right side of your screen you'll see a Q&A box. You can feel free to submit your questions throughout the presentation. We'll reserve responses until the Q&A period at the end of the presentation. Have approximately 10 to 15 minutes to cover that. So without further ado, I'll turn it over to Jason.
All right, fantastic. Thanks very much, folks. Always a pleasure to join you guys for these sessions. Of course, tonight we're talking about options spreads trading. I just would like to get a quick confirmation that my audio is working before we actually go any further, so perhaps the guys over at BMO can maybe just give me a heads up in that regard.
We can hear you fine, Jason. Thank you.
Okay, perfect. Now, just another comment before we start moving forward. I'm not able to actually see the questions that are being typed in for from our attendees, so you guys on that side are going to have to moderate that as well. So I'll just assume that we will wait to the end as per usual, and I'll just push forward through the presentation. If there's anything, you can just stop me for a clarification. If not, we'll just take care of it at the end. All right, perfect, guys. So with that in mind, let's continue to move forward here. As always, we just want to remind everybody that the information during these sessions are for informational purposes only. I like to include a lot of relevant examples in my presentations just so that you guys can see the practical application of the strategies that we're discussing, but by no means is it a recommendation for you guys to go out and actually start placing the trades. We want you to recognize, of course, that just like any market, the options market has its risks as well, and you need to make sure you understand them before you go in and start taking action for yourself. So we've got a lot to actually cover this evening. The first step is we want to take a look at just what an option spread is, and then we're going to get in and take a look at a couple of different types of spreads. There's really two types of spreads that we would look at from a general perspective. One is a debit spread, in which case we're going to discuss bull call spreads and bear put spreads. The other is a credit spread, in which case we're going to talk about bear call spreads and bull put spreads. So it can be a little bit confusing at times, so this is why it's very important that you guys make sure that you do spend some time reviewing the content before you actually go in and try to do this for yourself. So an option spread in general is just really the simultaneous purchase of one option contract and the sale of another. And that's really one of the great advantages of the options market, is that because option contracts trade independently from one another, we can actually construct some very interesting strategies within the market to take advantage of all sorts of different market conditions and to meet all sorts of different objectives. So in the case of the examples that we're going to discuss here this evening, the spreads that we'll be referring to all have different strike prices, but we can in fact construct spreads that also have different expiration dates, or we can construct spreads that actually have different strikes and different expiration dates. Again, it all just depends on what we're trying to accomplish. Now, of course, typically these are applied to the same underlying security, so that could be a spread on a particular stock, or it could be a spread on a particular ETF as well. But for the most part, we're looking at the same underlying security, but we're going to the options market and we're using different strike prices, or in some cases different expiration dates, or as mentioned, both. Now, the reason why they're referred to as a spread is simply because when we construct the trade, either the profit potential for the strategy or the risk associated with the strategy is the difference between the option contracts that we're using, which is referred to as the spread. So the spread refers to the difference between the strike prices that we selected. Now, a debit spread incurs a cost or a debit to our account, hence the title Debit Spread. What happens is we were actually looking to buy an option contract, and that could be a call option or that could be a put option, dependent upon what our directional bias is. And if we would like to offset the cost of that particular option contract, we can turn around and we could actually sell another option contract, bring in a credit to the account, and that credit from the sale of that option contract or the short option will offset the cost of the trade, pardon me, which reduces the break-even point of the position. So there's some pretty fantastic benefits in learning how to implement a debit spread, because what you can effectively do is participate in a directional bias on an expensive stock that typically would have expensive option contracts. You could lower your cost basis, as a result lowering your risk exposure, and when you lower the cost of your option contract, or the net cost of your option contract, you actually lower your break-even point, which ultimately requires the stock to move less in your favor for you to recognize a profit. And so we have to recognize that anytime we look to combine option contracts in these types of strategies, there's going to be a trade-off, and a lot of times that's something that many novice options traders fail to recognize, is that for every positive benefit or positive characteristic to an option strategy, there's always going to be some little trade-off that you're going to have to come to terms with. So for the debit spread, we actually end up losing the upside profit beyond the written strike. So you have to understand that as soon as you sell the option contract, or an option contract as a combination in a debit spread, you've immediately just capped that upside potential. Now that's not necessarily a bad thing. We want to recognize that there still is significant potential to profit with a debit spread. It just simply means that you're unable to catch a continuation of a move beyond the written strike price. Now, why would we use a debit spread? Well, if you guys have been tracking the markets over the last couple of weeks, not so much over the last week or so, but back towards the end of January and the beginning of February, you'll recognize that the markets actually, in general, underwent a fairly volatile sell-off. And so what happens is when the market appears to be risky, or when there's an expectation of a significant move, implied volatility within the options market expands, and that is just simply the market makers ultimately pricing in risk. And so that, for the most part, makes options expensive relative to other periods within the market. And so one of the ways that the debit spread comes in handy is in offsetting the implied volatility variable that affects the cost of the option contract. The other consideration is that expensive stocks typically have expensive option contracts. So if you're somebody with a smaller account, or if you're somebody that just simply wants to reduce your risk exposure on a stock that is trading relatively expensive to other stocks within the market, then the debit spread does a really good job at lowering the cost of the option contract. And then finally, if you want to lower your break-even point, so we want to recognize, if we go back to options trading 101, that if we buy a call or we buy a put option independent of one another, so on their own, the break-even point is going to be the strike price. In the case of the call, the strike price plus the premium that we've paid. For the put option, it's going to be the strike price minus the premium that we've paid. But if we hold this position until expiration, the stock actually has to be trading above the strike and the plus the premium, or below the strike minus the premium, in order for us to break even. So by utilizing a spread, we lower that break-even point, and the stock doesn't have to move quite as much for us to get ourselves, as I mentioned, into a position of profitability. And then finally, if an investor just simply wishes to lower their capital output and risk exposure, it becomes a very, very powerful strategy as well. Now, one of the things that we want to recognize, and this doesn't matter what type of options combination you're looking to implement, as soon as you start creating these combinations, you actually begin to offset the option Greeks. And the option Greeks essentially is the collective term given to the various or the different pricing variables that influence an option contract on a minute-by-minute, day-by-day basis. And in certain circumstances, changes in the option Greeks work for us, and in certain circumstances, changes in the option Greeks work against us. But it's all a function of mathematics. So as soon as we introduce a an additional option contract to the position, we start offsetting the Greeks, so to speak. And so as we create this spread combination, we're influencing the impact of the different pricing variables, and as a result, we need to actually manage our expectations. And I have found in the past with a lot of our students that they've looked at specific strategies, thought they were fantastic strategies to implement, but failed to recognize just how they changed the dynamics of the profit potential, or they failed to recognize how they changed how a move in the stock was going to impact the position, and they've ended up disappointed. So we've got to learn to manage our expectations. So let's take a look at a bull call debit spread. And let's just kind of dissect this terminology here for a moment. If we are bullish on a particular stock, we have an expectation that the shares are going to move higher. As a result, if we're typically looking to participate in a directional move in the stock utilizing an option, we would select a call option. Now, the difference is that in this case, we're going to be using a call option, and we're going to be using call options. We're going to be creating a debit spread to participate. So our outlook is going to be moderately bullish, and I say moderately bullish because we're actually, as I mentioned earlier on, going to be capping a portion of our upside profit potential. And so, at the end of the day, if we felt that the stock was just going to start moving to the upside and never look back, and that there was no resistance level standing in its way, then we would just be perhaps more inclined to simply buy a call option. So we want to understand that we have to take into consideration certain market conditions or our general outlook on a particular stock to determine whether or not this particular strategy is the appropriate strategy to utilize. Quite simply, what we're going to do is we're going to buy one call option, and of course that gives us the right to own the shares at a particular strike price. But then we're going to simultaneously sell a call option at a higher strike price. That's going to create an obligation. Now, if we looked at these positions independent of one another, then you'd recognize that when you buy the call option, you have a limited risk exposure, and you have an opportunity to take advantage of the stock's upside. As the stock moves higher, that call option will appreciate in value. If we look at just being an option seller, what happens is we get paid a premium, and we create an obligation to deliver the shares at the written strike regardless of how high it goes. Now, independent of having that long call in place, the call option writer, the person selling the call option, would have an unidentifiable risk exposure and would ultimately be required to put up a significant amount of margin to hold that short call position. But if you think about your rights and obligations, even if the shares extend beyond our written strike, we still have the right to own them at a much lower price. And because of that, the broker will recognize that your maximum risk, regardless of how high the shares go beyond your written strike, is just simply limited to the premium that you've paid. So again, you'll do this on the same stock or the same exchange-traded fund. And in this case, because we're going to keep things simple, we're going to do it on the same expiration date. So I was looking at Blackberry earlier on in the month. It was actually trading in at around $10. It's off of that a little bit. But Blackberry, while it's not an expensive stock, from the perspective of its implied volatility, it's pretty pricey because it's a very, very active and unpredictable stock. And so we could actually go out, we could buy one March call option, and we could pay $1.10. So that was the asking price at the time, and that would be a debit to our account. So that $1.10 per share, or $110 per contract, would come out of our account. We would then turn around and we would sell one March $12 call, and we would bring in 45 cents, and we can sell that $12 call at the bid price. So remember that we buy at the ask and we sell at the bid. So that actually becomes a credit to our account. The net cost basis of the trade is now sitting at 65 cents. So when we take a look at how this would look on a price chart here, what we've done is, let's say we've looked at research in motion here, Blackberry pulling back, coming down into this $10, $9.50, $10 range. We have an expectation that it's going to turn around, and it's likely going to come back up and hit this resistance level here up at $12. Well, if we don't feel over the next month that it's actually going to trade beyond that, then why not buy the call at 10, but then subsequently sell the call option at 12. Now, our maximum profit potential here, as we'll work through in a moment, is the difference between the long call and the short call. So this is a $2 spread, and we're really just taking advantage of a chunk of the potential move. Now, the way that I actually look at this is I can take a stock and I can kind of take bite-sized pieces of a potential move to the upside. So in other words, as an example, if I see that the stock is actually moving in my favor, I can take advantage of this this $10 to $12 bull call spread. If the stock looks like it's going to continue on to the upside, I could then turn around and in the Canadian options market, we could buy options in dollar increments on many of the stocks. I could turn around and I could do a $13 to a $15 strike. So while I am limiting my upside to a certain extent on this particular position, I can still take advantage of an extended move to the upside just by simply adding in another call spread. So the way that we calculate our profit here is we take the spread differential minus the net debit. Now, an interesting consideration here that I run into quite often is that, you know, folks will say, well, look, I think that the stock is going to go up to $15, so I'm going to turn around and I'm going to, you know, why limit it at 12 when I could sell a $15 strike call? What you're going to find is that typically your risk versus reward is going to be the exact same. So, you know, for example, you know, it may cost, you know, close to $1 for a $2 spread. If I went to a $4 spread, it's likely going to cost me close to $2. If I went to a $10 spread, it's likely going to cost me close to $5. So at the end of the day, you're not actually, from a percentage rate of return standpoint, any further ahead. So the reason why I like to do the narrower strike intervals is because it lowers my break-even point, and it gives me a much higher probability that the stock is going to be trading above that written strike, and I'll be able to benefit from the full spread. So what I want you guys to take a look at here, and I know we haven't really gotten into discussing option greats in any great detail, but essentially this is what we would consider when creating this spread strategy. Now, you don't necessarily have to go in and calculate this out yourself, you know, every time you want to put a spread in place, but I wanted to show you guys just how this particular strategy in combination really changes the dynamics. So, for example, we already recognize that you know, we change the net cost of the position when we implement this strategy. But what we also want to recognize is we influence the impact of implied volatility. So, for example, when I'm long an option contract, that implied volatility known as the vega becomes a positive variable, and I'm paying for that. So the higher that vega is, the more expensive my option contract is from a volatility standpoint. But what you'll recognize is that when we sell the call option, we're actually collecting vega. So it ultimately serves to offset the net vega of the position. So when we're in a situation where we really want to factor out the implied volatility variable as effectively as possible so that we are more so taking advantage of a stock move, then this spread strategy becomes very, very powerful. You are essentially in a market environment when implied volatility is very, very high. What you're doing is you're using a spread strategy to completely take that out of the equation. Now, the difference is when implied volatility is low, an expansion in implied volatility can work in the long call option holder's favor. So we actually remove that benefit from the equation. So this is where we need to make that determination if the option premiums are expensive from an implied volatility perspective, and do we want to try to offset that. The other benefit is from a time depreciation standpoint, and the Greek name for the time depreciation variable is the theta. So anytime you buy an option contract, you are in fact in a situation where that option premium is losing value by the rate of its theta. So you'll see that March $10 call option has a theta of negative 0.0112. But what you'll notice is when you sell the $12 strike call, it becomes a positive theta, because time depreciation works in favor of the option writers. So you essentially create a little bit of a time hedge here as well. It offsets that impact of time on a day-to-day basis, so it allows you to kind of weather out some days when the stock is doing nothing, because ultimately that time depreciation is hurting your long call, but it's actually working in your favor with the short call. Where I find that a lot of folks kind of misunderstand the strategy is when we take a look at the delta. The delta is a reflection of how much the option contract is going to appreciate in value when the stock actually goes up by $1. So you can see here that on the initiation of this trade, that March $10 strike call had a delta of 56 cents, basically 0.56, which is every time the stock goes up $1, the option contract would go up 56 cents. But that being said, for the short call, if the stock goes up $1, that short call is going to go up 29 cents. Well, you're short that call option, so that becomes a negative impact on the position. So you'll notice that your net delta is significantly reduced because you've created this spread. So what that means is if the stock goes up $1, instead of your option contract appreciating in value a little bit more attractively, it's only going to appreciate in value by its net delta. And I've seen many folks, see their stock, the stock position that they've created, jump really, really nice in a very short period of time. But because of the impact on the delta, what ends up happening is as they're a little disappointed by the response. So that's one bit of a trade-off. What we need to have happen in order for our position to really benefit to its fullest potential is we need to have the stock trading above the written strike on expiration, and that's when all of the time value is factored out, all of the vega and the theta are all balanced out, and you have a pure a position that is based solely on the intrinsic value of the long call versus the intrinsic value of the short call. So it's important to remember that in order for this strategy to meet its full profit potential, it has to be on the date of expiration. Now, that's not to say that you can't make a very attractive rate of return by closing the position prior to, but it's just important to manage your expectations as as the market is moving in your favor, that you're not going to get that full appreciation until expiration. So how do we calculate out our max profit? Well, it's simply the spread minus the debit. So if we're able to collect 65 cents, the spread's $2. Our maximum profit potential here is $1.35. And so what I want you guys to consider is, even though we've capped our upside potential on the stock for a 65 cent risk, we ultimately have the upside potential of $1.35. So if you think about it from the perspective of of your risk versus reward, it becomes a fairly attractive proposition here. Now, our break even is the long option strike plus the debit, so we're going to add the debit to the long option strike, and that's where the stock has to be trading above on expiration. Our max loss is essentially the net debit. So this is a strategy where your broker is not going to require you to put up any additional margin, because you cannot lose any more than the premium you've paid for the net combination. So the bull call spread becomes a very interesting risk versus reward proposition. As a general rule of thumb, when I'm personally looking to construct these trades, I don't want to pay any more than 50% of the spread. So the most I would look to pay for, let's say, a $2 spread on Blackberry here would be $1. If you can get it for less, fantastic. But I want to make sure that at the very least I have 100% upside potential. Even though I may not recognize that full 100%, I want to make sure that I have a 100% upside potential for the risk that I'm actually allocating. Now, the other way that we can approach this is we can take a bearish stance on the market, and we could do a bear put debit spread on a stock that we feel is going to sell off. And so our outlook is moderately bearish. We're going to buy one put option, and then we're going to sell one lower strike put option at distance away from the purchase strike that we feel is appropriate. Again, it's going to be on the same stock or exchange traded fund, and we're going to use the same expiration date. So in this particular scenario, I was looking at Potash February 3rd trading in and around that $35 mark. There is if we go out to April, the 34 strike April put was trading for $1.35. So you could buy that put option, pay out $1.35 debit, and then turn around and you could go $2 down to the next strike, and you could sell a 32 strike put for 65 cents. That becomes a credit to your account, and the net cost basis of that spread becomes 70 cents. So your 70 cents has the potential to net you out $2. So the way that we would look at this from the perspective of our charts is we would go down and we would be selling those buying those 34 strike puts with the expectation that the stock is going to drop in value. And again, if we thought that the stock had unlimited downside potential, well, you know, we would not look to cap that downside profit potential. But because we perhaps see that there's some support coming in down here around that 32 level, what we want to make sure that we do is we actually want to make sure that we sell off that option contract down at the 32 strike in order to offset our costs. And so we would buy the 34. We would ultimately sell the 32 here. And again, our profit is our spread, which is $2 minus our debit in this case. So once again, we have to understand that we have completely changed the mathematical properties of this particular strategy just based on offsetting the different option pricing variables. So of course we recognize that, you know, we've lowered our cost basis, but at the same time, once again, we've offset the cost of volatility, and I think that's a very important consideration. You know, during market conditions that are quite bearish, what happens is implied volatility actually skyrockets very significantly, and so that means that for the option buyer, options become quite expensive. And so when we have a strategy where we can offset that implied volatility variable, which is known as the vega, we need to consider using them. So in this case, you can see that the long put as a positive vega, the short put as a negative vega. We ultimately offset that net vega down to a very, very low level here. So and a level which almost makes it a non-factor. Whether implied volatility expands or contracts, we actually are indifferent to that. We also, again, create a little bit of a time hedge. So we offset the impact of theta so that on a day-to-day basis we're not suffering the full depreciation in time value that the long put holder would be having to manage for. But again, the trade-off is the long put has a negative delta of 0.41, and that's just traditional for put options. Calls have a positive delta, puts have a negative delta. So what we have to do is we just have to recognize that our long put has a negative delta of 0.41, our short put has a positive delta of 0.23, which means that the net delta of the position is ultimately negative 0.18. So we reduce the impact on the position in terms of its profitability as the stock drops by $1. But again, what I want you guys to sort of figure out here is look at it based on a risk-reward, from a risk-reward perspective. You know, if the stock drops $1, we can make 41 cents on our $1.35. How does that compare to if the stock drops $1 and we make 18 cents on our 65 cents? So rather than you know, looking at it and saying, well, you know, I've completely reduced the my delta here, which means I'm not going to profit as much, look at it as a percentage rate of return for the risk that you're actually taking on, and you'll see that it puts things into a much more interesting perspective. So the way that we would actually figure the difference here, and I noticed that there's a bit of a typo there, guys. The cost of that spread is going to be 70 cents. So if our spread is $2 and we subtract our cost, then our profit potential is going to be 70 cents. So it becomes a very, very attractive risk versus reward proposition. And our break even is the long strike minus the debit. So in this case, we take the 34 strike minus the 70-cent debit, and the stock needs to be trading below $33.30 in order for us to break even. Our max loss is capped at the credit, or sorry, at the debit that we've paid out. Now, why we would use debit spreads, once again, reduces the cost of implied volatility. We've demonstrated that mathematically by looking at the vega of each of the positions and mathematically offsetting those two variables. It mitigates the impact of time. Again, we demonstrated the adjustment of theta. We also reduce the break-even point by lowering the cost of the trade, but we must manage our performance expectations due to the offsetting of the Greeks. And also, we have to come to terms with the idea that we've lost the upside profit beyond the written strike. You know, before you actually implement this strategy, you truly want to evaluate the stock and make a determination as to what is more important, lowering your cost and your break-even point and the impact of implied volatility, or being able to take advantage of an uninterrupted move to the upside, or an unlimited move to the upside. And you know, if you think the stock's going to move you know, unlimitedly higher, just simply buy the option contract. Now we're going to change speeds a little bit here and take a look at credit spreads. Credit spreads are strategies, or is a strategy where we're looking to be the primarily the option writer, and we're looking to collect a premium to generate cash flow. So we're going to sell an option contract for a credit and put the impact of time depreciation on our side. The challenge, of course, is that for the opportunity to collect that full credit on expiration, provided that it's out of the money, but for that opportunity, we actually, if we just simply sold the option contract on its own, we have an unlimited and unidentifiable risk exposure, and the broker is going to require us to put up a substantial amount of margin in order to hold that position, because what we've done is we've ultimately created an obligation to buy the stock at a certain price no matter how low it goes. But we would use a bear call spread. So notice there's a little bit of a contradiction in terms from the perspective of the way we usually look at it. We would use a bear call spread when we think that the underlying is going to stay below the written strike within a specific time frame. So the idea is that we want to sell calls with the expectation that the stock is going to trade lower below those calls. As a result, we're creating a bear call spread. We would use a bull put spread when we believe the stock is going to stay above the written strike, and so as a result we're bullish on the stock, or moderately bullish on the stock, with the expectation that it's going to stay above the written strike. Now the trade-off, as I mentioned, is that when we actually sell an option contract naked, which is what we would refer to as just selling the contract without any without any additional option contract in place to identify risk, we have an unlimited risk exposure. So what we do is we still sell, in the case of the bear call spread, we still sell the call and collect a credit, but we're going to turn around and we're going to buy a call above the sold strike to limit our potential losses. And what happens is the cost is subtracted from the credit we received. But because we collect a higher premium for the, let's say, for the at-the-money call than what we have to pay out for the out-of-the-money call, it still is a net credit to our account. And if the underlying is at or below the written strike, we keep the credit. So here's an example. Agrium was trading at $96 on the 3rd of February. We could sell a 100 strike call option and collect $1.45. So we'd sell that at the bid, and $1.45 per share would come into our account. Now, if we just did this on its own, we now have created an obligation to sell those shares or deliver the shares at 100, no matter how high the shares are trading above that particular strike price. That creates an unlimited and identifiable risk exposure, and one that the broker will require to be backed up by having sufficient margin availability in your account. So the way that we actually reduce that margin requirement is we turn around and we buy a higher strike out of the money. So you can see here we could buy the March 105 strike call, and 50 cents out of that $1.45 is going to come out of our account. So we get a credit of $1.45. A debit comes out of our account of 50 cents. At the end result is that we collect a net credit of 95 cents. Now we want to recognize that our maximum profit is significantly, well, I should say significantly, is limited to the credit we've received. We can't make any more than, in this case, the 95 cents that we've brought in as a net credit. Our break-even point is the short option strike plus the credit we received. So in other words, as the stock trades above the 95-cent credit, we begin to incur a loss, because what happens is that 100 strike call option begins to go in the money. So if we collected 95 cents premium, we could give that 95-cent premium back if the stock's at 195, and it would be a wash. Of course, I'm not considering commissions, right? Our max loss, on the other hand, becomes a little bit more of an important consideration, because we actually have to look at subtracting the spread differential of $5, or look at subtracting our net credit from the spread differential, which means that our risk is $4.05. Now, we can manage for this, but what we need to understand is that the risk-reward proposition here is a little skewed. We're risking more than we're actually collecting in profit. But the benefit is that as long as the stock goes up a little bit, stays the same, goes down a little bit, as long as it stays below that $100 price point, then all the options expire and we make our full credit. Now, for the bull put credit spread, the consideration is the other way. We actually want to sell puts at strike prices below the current underlying value, with the expectation that the shares are going to continue to trade above it. So we would receive a credit, and ultimately we have to understand that essentially we basically have the same risk by selling that put as we do owning the stock at that particular price point. The lower the shares trade below the strike price, the the more risk we're actually incurring. And so what we need to do to cap that risk exposure is we buy a put option below the sold strike to limit the potential loss. And again, if you go back and consider your rights and obligations, when we sell the put, we have an obligation to buy the stock at a certain price. When we buy a put, we have the right to sell it. So if the stock drops significantly over the course of the time frame of this option strategy, we would have an obligation to buy the shares up at the higher strike, but we'd have the right to sell them ideally well above the current market value. So that caps our risk exposure. The cost of that put purchase is subtracted from the credit received, and if the underlying is at or above the written strike, we keep the credit. So an example would be Barrick trading at $21.50, a little higher right now, but we could sell the March 20 55 strike put and receive a credit, and we could then go down and $2 out of the money, sell an 18 strike put, buy an 18 strike put and pay out 15 cents. So our net credit is going to be 40 cents. Our maximum profit is the credit we've received, 55 minus 15. So if the stock is trading anywhere above that $20 put that we sold, then we make our full credit. If the shares are trading anywhere below $19.60, which is our short option strike minus the credit, then we start to incur a loss. And our risk, you'll notice that we've limited our risk exposure here by adjusting the strikes, is our maximum so the maximum loss is the spread of $2 minus the credit that we've received. So our $1.60 risk, provided the shares stay above $20 in this example, is going to net us out 40 cents per share. So if we look at it on a little bit of a larger scale, if we put up $1,600 in cash, we have the potential to make $400 in the credit. But again, we want to understand that the risk-reward profile is skewed. There's more risk than there is profit that we're actually having the potential to generate. But the benefit is that it's a relatively passive strategy whereby the stock can be moving a little bit here and there, and you just need to only manage the position if the stock starts to trade, if the option contract starts to trade in the money. So the benefit of the credit spread is that we take advantage of time and volatility decay. So as the option contracts lose value, whether it's through time or volatility, we're going to benefit. We actually have a defined maximum loss as the option writer. We can't lose any more than the premium we can't lose any more than the spread minus the premium that we've collected. So there is a greater loss, but it's actually identified, and as a result, we only have to put up a portion for margin requirements, which again is the difference between the strikes minus the premium. We create static income. So the idea is that if you do this as a component of your non-registered strategy, so you can't do this strategy in your RSPs or TFSAs, but if you do this as a component in your margin account, you could generate some consistent cash flow and just take advantage of time depreciation while you're maybe trading some directional views on other stocks that are looking like there's an opportunity. So guys, we'll take an opportunity to take some questions here, but I just wanted to reference some of the resources that the Montreal Exchange has available. At optionsmatters.ca, you can jump on there and check out the blogs of myself, my partner Patrick, as well as Richard Croft, where we're able to provide a little bit more insight and ideas based on our own observations, sort of free of any restrictions. There's also videos and webinars, trading guides, calculators. They have a really fantastic option simulator that you guys can take advantage of as well. That gives you an opportunity to test drive some of these strategies, during real market conditions. So all of this information can be found either at m-x.ca or m-x.tv. So I'll pass the controls back over to the folks at the BMO there, and I'm happy to answer any questions as we finish up today's session.
Great. Thank you, Jason. Just a reminder to all registrants on the phone, you'll see a question dialog box to the right of your screen. You can type in your question. We'll see it here. We'll endeavor to answer all questions submitted, although due to the high volume of participants on today's call, we may not get to everybody. So, Jason, I'm wondering if you can explain the difference between a covered and uncovered position. Hello, Jason, can you hear me? Okay, just apologize to everybody on the line right now.
I was actually muted there for a second, my mistake. So, so when we actually look at determining the difference between a covered and uncovered position, the easiest way to consider it is looking at the covered call strategy. When we sell an option contract, we create an obligation. And so, for example, if we were looking at a stock that we owned that was trading at $20, and let's say we sold a $22.50 call option, well, we've created an obligation to deliver the shares at $22.50. That obligation is covered by the underlying shares that we own. So the broker recognizes, okay, you've got the shares, doesn't matter how high the shares go, you already own them, you don't have to go out and buy them in the market at an unidentifiable price. When we look at it from the perspective of being uncovered, the difference would be you sell the call option, and but you don't have the stock, but you still have an obligation. And so let's say you sold that $22.50 call and the stock went up to $30. Well, ultimately you would have to go out into the market and buy the stock at $30 and sell it for $22.50. So you have a situation where you have an unlimited and unidentifiable risk exposure, and the broker is going to want you to put up some capital for that. When it comes to looking at put writing, a naked put would also be considered a cash covered put. So in other words, you sell the put option, but you have the sufficient enough cash in your account in order to buy the obligated shares at the specific strike price. So anytime you're just selling an option without an associated, without the associated share ownership, or without implementing another option contract that sort of offsets that obligation, it would be referred to as uncovered. So in effect, the spread strategy that we talked about, the credit spreads, are covered positions. There's still a risk, and it still is something to consider, but you have covered your obligation to a certain extent.
Thanks, Jason. And how does your expected move factor into your choice of strike prices when going into a spread position?
Did you say, sorry, expected news?
Expected move.
Expected move. Okay. So if I'm looking at it from the perspective of a bull call spread, let's say, or bear put spread, as I mentioned earlier on, I may have an expectation that the stock could move $10, but I recognize that I could kind of take advantage of that move in bite-sized pieces. So, for example, I will typically do, depending upon the actual stock and the options available, but a $2 to a $5 spread differential, looking to lower my cost basis, lower my break-even point, and take advantage of the move that way. And rather than, as I mentioned sort of earlier on, yeah, we could widen out the spreads, but it's going to cost us more. So I'd rather keep the spreads narrow and buy more of the contracts, and I have a higher probability of being right about the move, because ultimately the stock doesn't, if maybe I'm a little over ambitious with my forecast and the stock moves half of what I expected, I'm still in a position of profitability. Whereas if I widen up the strikes and the stock didn't move as anticipated, then I could find myself at a loss. I'll generally go at the money as well, because again, at the money puts me in a situation where the stock really just has to move the net premium from the price point that it's at currently, rather than having to move a certain amount and then hit my option contract and then move into a position of profitability. So it's really about positioning around where the stock is presently and trying to lower the break-even point as effectively as possible. For credit spreads, I try to write as far out of the money that makes it worthwhile to do, which kind of sounds, it's a little open-ended, but the further out of the money I can go with a credit spread, I may collect less premium, but ultimately I'm going to have a higher probability of those options expiring worthless. So it's just for the credit spreads, for me anyways, it's a function of probabilities, and the further away I write, the less I have to worry about it on a day-to-day basis, and the higher the probability the options are going to expire. And I also, with credit spreads, try to do as narrow a range as possible, generally $2, and I usually try to focus on ETFs, because with ETFs you don't have to worry about earnings reports or substantial volatility. And that's the other thing, if you're going to do it on an individual stock, make sure there's no earnings report coming out within the time frame, because it could really have a big impact on your position.
Great. Wondering if you can comment if there are particular spread positions that are best for sideways moving markets.
So for sideways moving markets, one strategy that you can utilize is what we call the iron condor, and it's really just a combination of a bull put spread and a bear call spread. So you identify the upper ranges of the sideways trending market, so the consolidation that's taking place. You sell the call credit spread above, you sell the put credit spread below. Your maximum risk is the greater of the two margins, so you don't have to put up you're not putting up any more capital from the perspective of your margin requirement, because you can only be wrong on one side, but you're actually bringing in a little bit of extra premium. So that would be one strategy that you could use for a sideways trending market.
Great. And just in terms of order execution, do you typically execute both halves of the spread at the same time, or are there situations in which you would leg into it?
No, I would do both at the same time. You can get fancy if you want and try to leg into it. Just recognize if you leg into the short side first, you're going to have a significant margin requirement and an unlimited risk exposure that you're going to be faced with until you actually get the long side in, and that goes for both the debit and the credit spread. I just find that if you've got an opportunity in mind and and it looks like it's worthwhile, just get it done and manage through it. Trying to get fancy, in my history anyways, has only ended up in being a headache. So I like to create the combinations together, and I offset the combinations together as well. Now, the only time I would actually I don't, or I will leg in, is in that example of a sideways trending market where I want to implement an iron condor. What I'll do is I'll look at the trade range of the stock or the ETF, and when the stock is at the upper end of its range, I'll sell the call credit spread, and then when it swings lower, I'll sell the put credit spread, because it allows me to get more premium for writing further out of the money. And so if there's already been a significant, let's say, downswing in the stock, then there's a diminishing probability that it's going to continue any lower. So I can kind of take advantage of that. And the same with the upswing. If I can write at the top of an upswing, there's a diminishing probability that it's going to go any higher. So I just have a higher probability of being able to write those contracts out of the money that are likely going to expire. That would be when I would consider legging in, but I'm still doing each credit spread together. I'm just doing the two credit spreads separately, if you guys can make sense of that.
Yeah. Great. And can you explain how dividends and stocks going ex-dividend would impact a spread position? Say you're at a bull call spread, how that might be impacted?
The only conceivable way that you may be impacted on a credit spread is, let's say, for example, so you sold a let's say you sold a call option at a strike that's very close to at the money, and that call option premium that you sold is currently worth less than what the dividend is being paid out. What would ultimately happen is you could conceivably be assigned to deliver the shares. So, for example, if and that would have to be actually if that call option is in the money. So, for example, if you sold that call and that call option is 1 penny in the money, then somebody could exercise their right. The call holder could exercise their right. You'd have to deliver them the shares, and then they'd get to essentially keep the dividend. But I would suggest that provided you are selling the provided that you're selling the option contract sufficiently out of the money and you're managing accordingly, you shouldn't find yourself in a situation where that's going to take place. And you should be aware of when the dividends are being issued. And I would just quite simply stay away from a stock that has a dividend being issued during that time frame. There's lots of opportunities out there. You can wait it out, let the dividend get issued, and then go in and implement whatever strategy you think is worthwhile.
Great, thanks. And in choosing expiration for when you're entering positions, what factors should a client consider?
So for me, a more volatile stock, I would go a shorter time frame. One of the considerations, as I mentioned earlier on, is that in order for your spread to completely maximize its profitability, you have to see it through until expiration. So the longer, the longer dated options you're using, the longer you have to sit and hold the position, and of course, the longer you hold that position, the greater the potential is that it could turn around and go against you. So for me, I would tend to personally implement, 1 month, a month and a half, depending on, of course, where we are at in the expiration cycle. Take it from a shorter term standpoint, because time depreciation, there's a delicate balance in let's say a directional debit spread. There's a delicate balance between the rate of time depreciation and the buildup of intrinsic value in your long calls. So you need both the stock to move in your favor, but you want it to do it at such a rate that the time depreciation is being offset by intrinsic value on your long option, but it's accelerating on your short option contract. So we do that by buying those option contracts that are close to the money at the that are near-term expiration, and try to find that balance. As far as credit spreads are concerned, for me, month over month, I just look at the potential deviation, standard deviation of the stock within that time frame. I try to sell credit spreads outside of that, and then and I look to collect that cash flow on a month-over-month basis, and that way I can also adjust my outlook as well, and it's easier for me to roll my positions and that sort of thing if I do happen to get on the wrong side of it.
Great. And you mentioned that you often put in spreads on ETFs somewhat to neutralize the volatility associated with earnings announcements. Can you provide some examples of ETFs and maybe comment on whether...
Well, let's just say, for example, XGD, the miners, XIU, which is the ETF that tracks the S&P TSX 60. There's a number of XLF, which is the financial. There's a number of Canadian-based ETFs that have sufficient enough options volume on them that you can use them. And what happens is, when any individual stock has an earnings report, there can be some near-term and significant volatility based on how those earnings reports come out. And when you're dealing with an ETF that contains a basket of securities, the earnings report of any one stock that's being held in that particular ETF is actually mitigated because it's one of, let's say, 10 stocks. And so, you reduce the chance of being getting hurt, because you've reduced the chance of a very volatile, one-off event impacting the position.
Great. And can you advise or comment on spreads with low combined open interest? Is there a disadvantage?
Yeah, stay away from them. The challenge, when we're dealing with any options with relatively, and let me actually, I should rephrase that. You want to focus on options contracts in general on stocks that are highly traded and that ultimately have a fairly active and reasonably narrow risk or reasonably narrow spread between the bid and the ask. Now, what's going to happen when you create a spread strategy is that your spread is actually the combination of the spread between your bid and ask of the long call, let's say, and the spread of the bid and ask between the short call. So you actually double the spread. You double the spread when you use a spread. So that is going to be a nature of the beast. If you focus on using options that in general have fairly close spreads, then it's going to be reasonably easy to get in and just put a limit order in to execute the spread between the bid and ask of the spread. I'm using the word spread a lot so in general, you want to stay away from inactive options. When you do a spreads are going to have a wider bid and ask. You want to try to put an order in between, and as I mentioned, as long as I can get, as long as I can pay 50% of the spread differential, I'm happy with it. If I can't get 50%, if it's a $5 spread, the most I want to pay is $2.50. If it's $2, the most I want to pay is $1. If based on the market I can't get that, then I don't want to participate. And so you could use that as a general rule.
Great. Okay, so I think that wraps up Q&A. Jason, thanks for a great presentation as usual. There are a number of questions that do remain. We endeavor to reach out to those individuals submitting those with responses within the next 48 hours. Also, some interest in viewing and hearing the presentation again. We'll be posting a copy under our options section within the client website within the next week or so. Certainly when you log out today, there will be a survey. Let us know what you thought of the presentation today and give us some feedback on future topics. So thank you, Jason. Thank you to the Montreal Exchange, and thanks to everybody for joining.
All right, thanks, guys. Have yourselves a great day. Bye for now.